Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. US and European equity markets look set to sell off as Donald Trump imposes the steepest US import levies in a century, with China facing a tariff of more than 50%. Beijing pledges to hit back at the tariffs, while the EU says it's preparing potential countermeasures if talks with Washington are unsuccessful. Gold hits a record as the haven trade ramps up as fears mount of a global economic slowdown.
Good morning. Let's take a quick check on those markets. And the futures picture that risk sentiment Anna was just talking about continues to spiral. It's even worse if you look at the U.S. relative to Europe. Take a look at this. S&P futures down a whopping 3%. Take a look at the NASDAQ, and there will be shock and perhaps a little bit of horror. Eurostoxx 50 futures on the other end still selling off, but not by the same margin, down by 2.2%. Anna there was talking about the haven trade. You're seeing a bid into treasuries, almost a a 3 handle on that 10-year yield. That's one we're going to keep an eye on. And in return, it's weighing on the dollar, boosting the euro almost to 110. The countdown to the opening trade starts right now.
China, 67%. That's tariffs charged to the USA. So we're going to be charging a discounted reciprocal tariff of 34%. European Union, they're very tough. We're going to charge them 20%. Taiwan, we're going to charge them 32%. Japan, we're charging them 24%.
Donald Trump closes the book on the post-war trading order and investors take fright. You can see it in equities this morning. Watch what is happening in foreign exchange. The safety trade certainly seems to be gold and treasuries. But Anna, the Trump bump becomes the Trump slump.
Yeah, absolutely. We're certainly seeing that. Risk off is one way to describe what we're seeing across various markets. The steepest American tariffs in a century, described as game changer. Our worst case scenario, Diane Swank at KPMG. So we are looking at what our guests think of these epic changes that Donald Trump has brought in. What that does to markets: Asian stocks down by 1.4%. Bonds are higher, yields are down. The focus is on growth fears. That seems to be coming through from bond markets. That's where the market's focus is. Commodities have dropped: oil, copper, cotton. The yuan is weaker. The dollar is also weaker. Interestingly, the yen, obviously, I suppose the yen goes higher, but the euro and the pound also catching a bid.
I'm going to say something scandalous here. I kind of thought it would be worse. I thought the
market reaction
moves, yes.
Yeah, absolutely.
I thought the market reaction would be more dramatic than it actually is. And I'm curious how much of that, or will go in the opposite direction, which is that the announcement is here, the risk event is here. Maybe we see a broader rebound. And neither one of those possibilities came to fruition. They're selling off, but not by as much as I think a lot of people were bracing for.
There's still a huge amount of uncertainty out there, isn't there? It was fascinating listening to Scott Bessent talking to Bloomberg last night, talking about the idea that he hopes that others will not respond. That response inevitably will come. We'll wait and see what form it comes and how long it takes for that response to come. But if there's no negotiation that results in a better outcome, then presumably the EU, China, others are going to hit the US in response, and we get into the spiral.
And then the US goes higher still, would be the implication of what Scott Bessent was saying. There are some exemptions to note, and that's important, but mostly they're places that have already been tariffed. So Canada and Mexico and all kinds of sectors: autos, steel, aluminium, lumber, semis, importantly, and some commodities as well. So perhaps that also takes a slight edge off, and we'll come to some of the reaction that we've seen, and maybe it is that. Maybe it is the nuanced nature of some of the reaction that is helping us not sell off too quickly. But I suppose this is just day one, and a lot of people are going to have to make judgments and guess how long these tariffs stay in place at this point.
What does the Fed do? We're going to find out Friday. Powell, I think, is going to be fascinating, how he responds to this. There's a note floating around out there, I understand, this morning that talks about inflation in the US being circa 5% by the end of the year. I'm not sure if it's an additional 5% or it's just 5%. I'm trying to get hold of that note. We'll see exactly what that says. But if inflation does go higher, does that slightly undermine the idea that we've got this growth fear as well driving the narrative? Because that would be stagflation. You get a growth slowdown, you get a massive pickup in inflation. That is the worst case scenario, you could argue, for many markets.
But the markets, I think, are pricing in growth over inflation as the key risk, which Jay Powell hasn't done to date yet. He said inflation is still the primary concern. Growth is, we'll see what happens. The resilience story is still there. But you're looking at this bond market here, 10-year yield at 4.04 at the moment, a 2-year that's already sub 4%, 3.79 on that. And I'm curious if that's simply because we're not seeing a bigger bump or expectation of that inflation because of the carve-outs that Anna mentioned. I also wonder what the China reaction is going to be, because that's going to be the biggest trading part partner of the United States. That's the key piece here. And already we're waiting for kind of official reaction, but just in the last couple of hours, you've already seen several moves coming out of Asia broadly, not just China, but where Donald Trump is saying, hey, these things can go away if you invest in the U.S. China is already making that harder.
China has vowed retaliation, haven't they? We've heard from them. But you were flagging, you know, this is a lot of key trading partners of the United States, key allies of the United States, so Japan, South Korea, Vietnam, for example, being hit by some of these tariffs. So 60 countries in total that get tariffed more than the 10%. Japan, South Korea in the mid-20% range, Vietnam around the 50%. And then, importantly, also for certain business models, but also perhaps people's shopping habits, the de minimis rules, well, they're just gone. The de minimis exemption for small packages, they seem to have gone. What does that do to the business models of the likes of Shein and Temu?
Pick up a pair of Nike training shoes. I'm sure you've got a pair sitting around right now. Look inside and see where they're made. That's going to be the effect. These kind of companies have huge footprints in not just China, but across Asia. And some of these economies are going to be really affected by this, and the trading lines that come out of them are going to be really affected by this. The US is drawing a line around itself. Yeah. This is the thing. It's basically going back to isolationism. This is a closed book economy that we're talking about here.
But this is where, if we're talking about somewhere to find the inflationary pressures, and we're not seeing it in the energy infrastructure, and maybe not semis, if these are the carve-outs that are starting to come out, and we're not necessarily seeing it in as much of the construction materials like lumber that you had mentioned, maybe we're going to see it in textiles. Maybe that's the inflation component, and that's where it comes from.
And interesting, we'll go on to talk about Europe. I note that Ursula von der Leyen, one of the things she finished her address with today was talking about how we won't tolerate dumping in the European markets. And so whether those Nike trainers don't go to the United States, but try to find their way into Europe, and whether all of our sportswear gets cheaper, we will see.
I think we'll see what happens with Adidas at the Open. We'll see what happens with Puma at the Open. I think those two stocks could be firmly in focus today. You bring up the EU, so let's talk about what we've got going on here. So Trump calls the European Union pathetic. That was the line that he used to describe the EU last night. He puts 20% tariffs on. He says the EU imposes a 39% tariff. If you do the maths on this, that basically means that he's including non-tariff barriers, he's including VAT, he's including things like chicken. So basically he's playing chicken with the EU. So that's the way I think we should maybe frame this. You talk about the Ursula von der Leyen response this morning. Quite measured, I thought, in terms of what she said. Countermeasures to come if negotiations fail. But how does this work, and what will the EU respond with? Remember that the EU runs a huge deficit in services with the United States. In 2023, that was 108 billion, i.e. that would be the area that you could target. That's where US imports into Europe are the strongest. So it's going to be really interesting to see how this works and what we're going to be looking at. The European Union very much vowing to retaliate, as I've already indicated. 20% tariffs coming through. Ursula von der Leyen has put out a statement. She says the move is a major blow. Take a listen to what she had to say.
We have always been ready to negotiate with the United States to remove the remaining barriers to transatlantic trade. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel. And we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
Ollie Crook is in Brussels. We don't know what the European response is going to look like. We're going to have to wait. That seems to be the tone this morning. Von der Leyen sounding cautious, I thought.
Yeah, Guy, I think that what is really interesting is the point that you made, and I think is the correct one, is say that they basically have these countermeasures. They're going to present them. They're going to have them ready if a negotiated solution fails. So the Europeans still want to arrive at that negotiated solution. They believe, it seems, that they can get there. I think that where the difficulty comes is that you've got these 20% tariffs, which we should say is on the higher end of what the EU officials were expecting. They were expecting something between 10 to 25%. You get 20%. It's obviously a lot better than they did out of China, but still not great for the Europeans. And in trying to appraise, again, when we talk about the Trump administration and their goals, is it to reindustrialize the United States? Is it tax revenues? Is it to open foreign markets out? These are all sort of different. Different policy goals that will sort of demand different things from these trading partners. But at the end of the day, the Europeans will try to negotiate something. But when you look at the trade barriers that existed between the United States and the EU before yesterday, right? It was only about half of a percentage point difference in terms of the actual tariff rate. So if you want to reduce the tariff rate so you can only bring it down to about 10%, you need to find 10% in something that is non-monetary, non-tariff, in order for the United States and the Trump administration to be satisfied. And that is the sort of term sheet that the European policymakers are going to now be assembling to present to the Trump administration, saying, hey, maybe we can do something on regulations for food safety standards. This is something Trump talked about last night. He was very upset about poultry basically being barred from the EU through sort of non-monetary, non-tariff measures. Is it going to be tech regulation? All of these sorts of things. And again, we should say all of this as basically Marco Rubio is on his way right now to Brussels, about to touch down at NATO headquarters in order to have the discussions where Europe is still very much dependent on the United States on defense and a negotiated outcome in Ukraine. So all of these things begin to bleed together. It's a very difficult cocktail for these European policymakers to put together.
Ollie, thank you very much indeed. Ollie Crook joining us from outside the European Commission in Brussels. I'm sure the grey matter is working at full pace.
Yeah.
I do wonder what thoughts they're going to come up with, though. And I do wonder how this problem gets ultimately resolved. Because Scott Bessent does seem to imply that for the moment, that's it. We don't want to talk. We just want to kind of let things settle down a little bit.
Yes, and I wonder how long that moment is, exactly.
Yeah.
And when can the talks start? Because Sefcovic, EU Trade Commissioner, has been there and didn't come back with anything. The Americans didn't want to talk beforehand, don't want to talk now. They will talk in due course, is the assumption, I suppose. But when those talks happen, it's interesting. What is the EU strategy? Are you trying to work with that equation that has been applied to Europe and take the various bits of it and try and tackle that? Or are you working to the rhetoric? Because they don't always match. You might tackle some of the things that are really bothering President Trump or other members of his administration, but they might not actually, in a monetary sense, have that much of an impact on that equation. So it's going to be a complicated game of politics to watch.
It absolutely is. I mean, you mentioned the chicken component. I think Howard Lutnick yesterday was talking about in interviews about beef and the lack of access that the U.S. farmers have to the European market. And by the way, this tariff stuff is going to hit the U.S. farmers the most out of everybody. So there is that piece of this as well. You mentioned kind of how the EU can I don't want to say retaliate, but maybe even negotiate. Regulation is a big piece of that, but that isn't something that can be done with an executive order or the EU equivalent of that. That is a court process that happens. So that isn't really one that they can use, even though that's what the U.S. is asking.
I just come back to the services deficit.
Yeah.
Great, we have a goods deficit with you, but you have a services deficit with us. Presumably there's some deal to be done
there. Not the area of President Trump's focus, but how do you make it so? Yeah. Let's get to some of the other things that are coming up in programming today here on Bloomberg TV, just after 9 a.m. On The Pulse. The team will be speaking to Jonathan Reynolds, the UK Secretary of State for Business and Trade, to get his reaction to President Trump's tariff. I should say, of course, the UK is subject to that 10% tariff, just like most nations are, not one of the 60 nations that gets a higher tariff. We'll be speaking also to the US Commerce Secretary Howard Lutnick on President Trump's tariff announcements. Now, this makes much more sense. We thought perhaps it was yesterday. Of course, it wasn't yesterday. It's taking place today. That interview is at 1:30 p.m. UK time.
We're going to get the market perspective on all of this as well. Laureline Renaud-Chatelain, Pictet Wealth Management, joining us very shortly to talk about what's happening in the fixed income space. Maria Demetzis, the Conference Board's chief economist here in Europe, is going to be joining us later. Karen Ward, JP Morgan Asset Management chief strategist, EMEA, is going to be joining us with her reaction, as will Sonia Martin, DZ Bank head of FX and monetary policy research. All of the markets covered.
Plenty of really strong conversations coming up on this program. Plenty of data in the next 24 hours as well. Remember, we are counting down to payrolls tomorrow, perhaps an early sense of the jobs market today. At 1:30 p.m. UK time, those U.S. jobless claims are going to be hitting the wire. 90 minutes later, it's all about ISM services. So we'll see if this data is even relevant, if this market is even trading that resilient story or lack thereof. And then, of course, as Ollie mentioned, we do have the NATO foreign ministers meeting, Marco Rubio touching down. And we are also, I just got an email that hitting my inbox that the new permanent representative to NATO from the United States is starting his stint today in Brussels. So we'll see if he has anything to say on day one.
What else do we need to know this morning? It is a busy morning. NATO Secretary General, to Kriti's point, Mark Rutte, says European militaries should, quote, step up as the US tilts away from the region to focus more on the threats from Asia. When asked about a media report of a potential US war planning with China, Rutte acknowledged a US pivot towards the Indo-Pacific region, but he added that Washington has no new plans to withdraw from Europe.
It is understandable also for the US that over time they want to focus more and more also on that part of the world. And it is only logical for the Europeans to step up even more.
Siemens has agreed to buy, if I can spit the words out this morning, the Boston-based firm Dotmatics for $5.1 billion. Dotmatics, sounds like an Asterix character, though. It's part of the German firm's push to provide more artificial intelligence software to life sciences companies. The transaction is expected to close in the first half of the fiscal year 2026. It's the sixth biggest deal Siemens has ever done. And Bloomberg has learned that Amazon has submitted a bid to the White House to buy TikTok's US operations from its Chinese owner ByteDance. The company sent its proposal in a letter to Vice President J.D. Vance and the Commerce Secretary Howard Lutnick, but a source has told Bloomberg that the administration is not considering Amazon's offer seriously.
Coming up on the programme then, we will dive further into all of these stories. The Chinese Foreign Ministry briefing hits during our hours. We'll be looking for further tariff reactions from Beijing. Plus, stay tuned for the European market open as global equity markets sell off. We are expecting to see that negativity at the start of trade. There's the European futures picture. S&P futures down 3%. Stoxx 50 futures down less than that. Read into that what you will. Up next, Scott Bessent asks trading partners to hold back on trade retaliation. We will hear from the US Treasury Secretary. Bloomberg TV conversation with him, and we'll talk more, of course, about markets. If you want to get involved in these conversations, please send us your thoughts. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation.
US Treasury Secretary Scott Bessent there warning trading partners not to fight back. But that's now the calculation that the market has to make, whether or not that is what we see. Let's get more detail on what is happening here with Valerie Teitel.
I want to walk through analysis from Bloomberg Economics on just how bad the GDP hit could be from these tariffs announced from the Trump administration. I want to start off with China. That whopping 54% tariff could see a GDP impact of 2.3%. And Bloomberg Economics says that nearly 80% of Chinese exports to the U.S. are at risk. Moving on to the European Union with a tariff rate of 20%, GDP impact could be over 1%. Bloomberg Economics sees it as 1.1%, Guy, and that 50% of exports to the U.S. from the EU are at risk. The U.K. is little scathed, but I also want to mention the number on the United States. This is using a Fed model from the 2018 paper. Our own Anna Wong used that for the calculations. They see the GDP impact on the U.S. of 2.3%, and that the inflation impact could last for 3 years. Moving on to markets, they are not taking this in a good way. S&P futures broke through the year-to-date lows in the Asia session overnight. Russell 2000 futures are the key underperformer here. That is off the back of these growth concerns. I also want to talk about the Treasury curve. We're seeing a rally led by the 5-year sector. Note that we are not pricing in any more action from the Fed when it comes to that May meeting, but the terminal rate has shifted lower. Maybe that narrative changes on Friday when we hear from Powell himself. Are we due to expect Fed cuts sooner rather than later?
Valerie, thank you very much indeed. Let's carry on the conversation, particularly when it comes to the fixed income narrative. Laureline Renaud-Chatelain, senior fixed income strategist at Pictet Wealth Management, joining us this morning. The market response has been fairly clear. We've seen a bid into treasuries. The market, therefore, is seeing a growth issue coming through. Do we need to worry about an inflation issue as well? How are you thinking about this narrative over the next few days and weeks?
Thank you very much for having me, and good morning. So indeed, what we have seen in terms of Treasury movement so far is really inflation-linked yields going down, but inflation expectation, when we look at inflation break-even, moving higher. And that is in line with our expectation that because of the tariff rate that has been announced yesterday, we would see core PC in particular, that is watched by the Fed, moving definitely higher than what we were expecting previously. And we see also in a recent survey that was a big concern from consumers and companies that actually inflation was going to increase. Now, I think the fact that the terminal rate is now priced lower from the Fed perspective is really linked to this risk in terms of economic growth.
Yes. So Lauren, I mean, the market does seem to be reacting to the growth fears rather than inflation, perhaps. How do you see opportunity to play inflation fears at this point?
Yeah, so what we have seen since the beginning of the year is really TIPS, so Treasury inflation-protected securities, outperforming nominal treasuries. They have a total return of around 4%. So that would be a place where market participants have been able to hide. Other, obviously, hiding places has been gold that has surged year to date as well. When we look at the inflation expectation, I would say that with the two-year break-even around 3.4% this morning, there is still a bit of upside, but the risk is really how long this tariff will be implemented and what will be also the long-term consequences on inflation, that there maybe you have more upside in terms of inflation expectation at the long end of the curve.
Lauren, it's Kriti in London. I'm looking at a 10-year at a 406 over in the States. What is the correlation between how the U.S. bond market moves and how the European bond market moves? Is there one, or is there a divergence, a wider divergence at play?
So what we had seen because of the German fiscal bazooka announcement is a wide divergence, I would say, with the German bond yield in particular moving sharply higher and the 10-year Treasury yield moving lower on the back of this economic growth fears. Now, the fact that we have these heavy tariffs that are imposed on the EU means that economic growth is also potentially a bit at risk in the EU. What we will look forward is to see if there are some countermeasures that have been announced by the EU or also at the state level that could mitigate, I would say, the economic impact on the EU. So that's something to monitor, because more fiscal easing on the EU side could, again, push some upward pressure on Euro sovereign bond yields, where we believe in terms of Treasury, the market will more focus on lower growth expectation and how much the Fed will be able to cut.
Lauren, how are you thinking about this? Is this over? We were just trying to debate whether or not the market is now waiting for the next part of this narrative, which is the EU response, which is the Chinese response. Is that how you're thinking about this? Are you waiting for that next element before you make big decisions on where you think these markets are going to go?
So we have already taken the decision to reduce U.S. high yield. So we're moved now on the weight on U.S. high yield, because we were a bit thinking that credit markets, especially the risky part, were not pricing enough this tail risk of lower growth in the U.S. and potentially more tariff. So this is already a decision we have taken. And then we always say that we see treasuries as a safe haven. And so that would be something that we will look for if we believe that the U.S. economy is heading into recession. So these are a bit the two things we're already moving, but obviously it's an ongoing discussion. But we're probably going to monitor very closely also Powell tomorrow.
All right, Laureline Renaud-Chitalan, Senior Fixed Income Strategist at Pictet Wealth Management. We thank you so much, giving us a roundup, of course, both sides of the Atlantic and what that bond market looks like. As she was speaking, of course, we did see German bonds open higher a few minutes earlier than usually scheduled. The 10-year yield there falling about 7 basis points to the open. We're going to dive more into the bond market and the fallout from President Donald Trump's sweeping tariffs. Coming up on the show, we're going to get the latest on the reaction from Europe and the look at their potential impact on the continent. We're going to speak to an economist over at the Conference Board. This is Bloomberg.
Welcome back. Thursday, the 3rd of April. We know now the U.S. tariff position, at least as it was announced in the Rose Garden yesterday and lingered on by all market participants, of course. And this is the market response that we are anticipating. European futures point lower. Is this the sum total of our worst fears or not? Interesting that US futures point lower and more so. So E-minis down by 3%, NASDAQ futures down by 3.4%. You wonder if the retaliation from Europe, if and when we get that, whether that will include anything around services. So that's where the European equity markets are expected to open, weaker, but down just that much, 1.7% or so. Bond markets, then, we've seen the German bond market opening up already and a little bit of movement there. And just as we're seeing in treasuries, the yield story looks to be a little bit weaker this morning.
We're about to get potentially an update on the US position. Marco Rubio is currently walking down the stairs. He is arriving at the NATO summit in Brussels. It'll be interesting to see what commentary he adds maybe into the tariff narrative.
He thinks he's there just to talk about defence. I mean, they're linked, but...
I think there is a connection. And the relationship between the EU and Europe and the United States, the Venn diagram overlaps, I would think, significantly between what is happening on the trade front, the reliability of the US as a trading partner, and the reliability of the US as a security guarantor, I should probably say, I think is a fascinating conversation.
Well, this is a crucial one as well, because if you remember, Kaja Kallas went to D.C. to meet Marco Rubio. She had arrived in Washington, D.C., and he had ultimately snubbed her and didn't end up taking the meeting, and she had to fly back to Brussels with very little to show. I'm curious if they are able to meet.
And she reiterated this morning, we must diversify our defence portfolio from US dependence.
There you go, Kaja Kallas, the number 2 at the European Commission, of course, the former Prime Minister of Estonia, weighing in on what's turning into a very escalating and scary situation for a lot of countries around the world, certainly in this region, which brings us right back to our top story. The reaction to President Donald Trump's bid to remake the World Trading Order has been pouring in from global leaders. Anna there mentioned Kaja Kallas. There are plenty of others as well, all bracing for the steepest American tariffs in a century. Let's bring in an expert who I'm sure is still wrapping his head around this as well. Bloomberg's Brendan Murray, who leads our trade coverage at Bloomberg. Brendan, what stood out to you here? There's a lot of math, there's a lot of numbers. Just walk us through the top lines.
Yeah, so in typical Donald Trump fashion, we didn't get a universal tariff number that applies to everyone, a nice clean round number that we could all write about this morning. We got the 10% baseline, and then we got 50 or 60 other numbers for various countries, depending on their perceived the U.S. perceived trade grievances with those countries. And so, yeah, so we're still pouring through the numbers, the formulas with which they use to come at these numbers. And if you're sitting in a capital of a big U.S. trading partner right now, you're trying to unpack this and to get to a point where you can say, well, what are we going to offer? How are we going to respond? Are we going to retaliate? Are we going to negotiate? It still leaves a large cloud of uncertainty over the outlook.
Does the US want negotiation on the back of this? Scott Bessent was implying last night that he just wants things to settle down, and he doesn't want to have talks immediately. He wants things to bed in a little bit before the talks start. But he also said, if you respond, it'll get worse. So I don't know how you negotiate. If I come to you and say, I want to negotiate with you, but if you don't negotiate with me, I'm going to make things worse. He's saying, I don't know how that conversation happens. What does the US want in terms of these negotiations?
Yeah, I think what that reflects is there are two pillars of Trump's strategy here. One is the let's try to rebalance the world economy back in the U.S.'s favor. And the other one is let's try to extract some concessions from trading partners that we've had these long grievances with. The other pillar is, of course, the revenue that they're trying to generate. So. And they're going to need that revenue to pay for tax cuts that they're trying to get through Congress. So there's definitely, there's the Scott Bessents among the Trump advisors who think that, there is some wiggle room for countries. But then there are the Peter Navarros and the Howard Lutnicks who say this is about, bringing manufacturing jobs back to the U.S. I mean, the whole spectacle yesterday had this almost like MAGA rally vibe to it. It was quite an hour and 15 minutes.
It was. In terms of the countermeasures that we're seeing being announced or at least talked about, because they are not being announced or implemented, and maybe that's the important takeaway. Yeah. But here in Europe, then, we've heard from Ursula von der Leyen. She says preparing countermeasures if talks fail. And Guy's already asked you about, where the talks go. But what are we expecting to see then in the short term from Europe?
So we'll have to see how this plays out. But it sounded to us that Europe wants to negotiate first rather than retaliate. This was the world's most widely telegraphed barrage of trade tariffs, and if Europe wanted to respond immediately, it certainly had all the time in the world to prepare for that. So, and we haven't seen that right out of the gate here this morning. We'll see how it plays out, but definitely the rhetorical war of words is going on, and we'll see if Europe responds quickly or not. Okay,
Brendan, thank you very much. Bloomberg's global trade editor, Brendan Murray, with the latest on the trade news flow, and there has been a lot of it. How does all of this play out for the EU? Let's talk to Maria de Mertzis, economies Economy, Strategy and Finance Centre Europe leader at the Conference Board. Maria, great to have your insights on the show once again. So we were all gripped by listening to Ursula von der Leyen this morning saying, yes, they're preparing countermeasures, but then crucially saying if talks fail. So how are you expecting Europe to respond in the short term here?
Well, it's step by step. The issue of negotiation will always be on the table because the EU is desperately trying to avoid an escalation. But they are preparing. We have already seen the 28 billion announcement of tariffs that are already in the shelf. They're going to take them out of the shelf and implement them as soon as they can. But that's not enough. If 20% is the tariff coming from the US, 28 billion worth of US exports simply is not enough. It's about a tenth of what is at stake here. I think the thing to watch is the anti-coercion instrument. This is in Brussels talk called the bazooka, and it will be an indication that we are in a full-fledged trade war. But they are seriously and slowly preparing for it. They had already announced that any tariffs coming from the US will be unlawful. That means illegal. In other words, the EU is arguing that the US is trying to coerce the EU into doing something they don't want to do that. And that, of course, goes well beyond tariffs. It will be quantitative issues, anything from restricted investments, prohibiting the function of digital firms, financial firms coming from foreign countries, participating in procurement, suspending property rights. All of these things are possible and they can happen, but they will happen gradually because they are still trying to negotiate.
Yes, Maria, this sounds like a slow burn then. If they're going to go down the ACI route, the bazooka as you call it, I know that requires some consultation and lots of players to sort of fall into line, which sounds like a sort of longer game than just a very immediate response. Can you link the use of the ACI with financial services? If Europe thinks, well, we've got to bring financial services or services broadly into the equation here, services broadly, how can they do that using the ACI?
They can by effectively suspending the operation of some of the financial services and the digital services. This is what they're looking to do. The one thing to say here is that the EU is an importer of this. In net terms, we are importing from the US when it comes to services, and that paradoxically gives us a lever. Because that is effectively what can hurt the US, because we actually have a trade deficit when it comes to services with the US. Economic factors and economic cost, in my view, is the only thing that will bring the US administration around the table. And this is, I think, what the European Commission is trying to do.
Maria, you mentioned that German kind of fiscal bazooka as well. Do you think that 500 billion euros invested over, I believe, 10 years' time is enough to at least maybe not completely offset the impact of these tariffs, but do it in part?
Actually, it's bigger than that. If you take both the rearmament and infrastructure investments, they can go up to 1 trillion. So it really is a very big amount just coming from Germany. And I think the answer is yes. Even if it hasn't happened yet, for the moment it's just a promise, you really see macroeconomic factors picking up, particularly in Germany, in response to that. So provided the new German government makes the promise reality, then I think, yes, we will see a fiscal stimulus that may actually eliminate some of the costs coming from trade.
So that's the fiscal stimulus of Europe. Let's talk about the fiscal stimulus of the United States, because as part of this kind of tariff agenda, Donald Trump, and he talked about it in his comments last night as well, has talked about tax cuts, minimizing the deficit. He quoted $6 trillion of investments domestically and coming in from abroad. If that is an economic plan that ultimately works and is able to pull the United States out of any sort of inflationary or growth hit that it might take, does that bleed into Europe? In other words, if the United States is able to attract that investment and benefit from tax cuts, does Europe feel the effects of that as well?
Yes, I think that, of course, is the big bet that the US government is trying. And there is a fear that EU firms will actually respond to that and migrate to the US to take advantage of that. That remains a fear. And it is important for the EU to try and contain that by keeping European money inside Europe, because we do have huge investment gaps. So we absolutely need that money to stay. It will actually depend a lot on the effect of these tariffs. And also I remind you that for these investments to migrate, you need 3 to 10 years. So it's not something that can happen this year or indeed the next year. It will happen well beyond the Trump administration.
Maria, given that, Where do you think the biggest economic hit is going to fall as a result of what was announced last night? I look at what is happening in the currency markets, and we talked about this yesterday. The euro is rallying. That would seem to imply financial markets expect actually the biggest hit to come in the United States, not within the EU. Is that calculation correct?
I think so, but it also takes into account the fiscal stimulus that the European Union is promising to make. It's not just the tariffs. I think that possibly the fiscal stimulus is more important in this balance that you see, rebalancing of the stock markets between the two continents. This is the big promise here. Can we make do of the promise that we have put on the table on rearmament and on infrastructure investment? Because that could make a big difference.
The UK has 10%. How does that complicate matters?
I don't think it does, actually. Well, it still has 10%. It's quite a substantive number. It's not as big as the rest of the world, but it still will affect the UK trade.
Do you think it'll affect UK trade with the EU? Do you think it'll complicate talks between the EU and the UK, the fact that we now see a different set of scenarios being put in front of the UK versus the EU?
Not at all. I think the defence discussions that are happening now with the UK, it basically means that the relationship is being normalised again.
Maria, can I ask you about the VAT line? Clearly, President Trump is not a fan of VAT regimes. They exist in a lot of the rest of the world. But part of his disappointment with them, if you boil it down, seems to be that sales tax in the United States in different states just tends to be much lower than VAT rates are around the world. And he sees VAT as an incentive to export out of Europe and elsewhere. Is Europe going to do anything on VAT? Is there anything Europe can do without reducing its fiscal take too substantially?
No, this is incorrect. The VAT is a neutral tax. It's a consumer tax. The consumer pays the VAT for all goods that are consumed domestically in the EU, irrespective of where they come from. So the fact that the VAT gives an unfair advantage just simply is not correct. It is the tariffs that are non-neutral and affect, of course, importers. So the VAT discussion is besides the point. We're mixing apples and oranges here. I think the issue is about corporate taxation. This is whether this is, I think, what it boils down to, and there is no difference.
No, I understand. I understand. There's plenty of people who say, look, there's no discrimination within Europe around VAT. That's well understood. But the Trump administration has a different view, and when they look at the impact of exports from Europe into the United States, they see them selling cars at different prices. They blame VAT. Is there anything that Europe can do? Anything they would be minded to offer to the United States on VAT? Any tweaks?
I don't think so. I think that is the VAT plays no role in this discussion. So I think we need to take it out of the equation. So there is no reason for the EU to respond to something that makes no sense. The corporate rates is what matters. But actually, if you look at corporate rates, they are on average exactly the same. And the main exporters from the EU to the US actually have corporate tax rates that are larger than those in the US. So even that is not a disadvantage. So I think this conversation is just throwing dust into the arguments. There is nothing that the EU can do there.
Maria, we're already seeing some of the global banks and some of the Wall Street banks come out with calls when it comes to monetary policy as well. I asked you earlier about the read-through from the fiscal in terms of the U.S. into Europe. Let's talk about the monetary. Morgan Stanley coming out and saying that the Fed will be on hold till March of 2026 off the back of this announcement. Guy was talking about inflation calls of something like 5%. How does that influence Europe? To what extent does Europe import inflation from the United States?
It does, worth equal to the amount that it imports for the US, which is about between 600 and 700 billion annually. So if that goes up because of tariffs, so the prices of those imports go up because of tariffs, then of course we will see an impact. For the moment, we don't see it in the forecast, and actually all the inflation forecasts that we have seen do not have any, if at least no significant increase in prices. But that, of course, is subject to huge uncertainties. The core inflation, which is, of course, what will be affected by those tariffs, can go up to 2.7%. We are forecasting 2.5%, but we see there is a spread between the forecasters. So I think we need to monitor that very carefully. And, of course, if it does come, then the ECB will have to take this into consideration. So for the moment, we are not changing the amount of changes in the inflation interest rates and inflation and interest rate changes we see, but we acknowledge that this is subject to huge uncertainty.
Yeah. as is pretty much everything, it seems, at the moment. Maria, great to catch up. Thanks for the time. Thanks for the analysis. We really appreciate it this morning. Maria Demetzis, Economy, Strategy and Finance Centre Europe leader at the Conference Board. Coming up, President Trump's sweeping tariffs are set to rewire global trade. We're going to look at how sectors including shipping, energy, luxury, how are they going to be affected? Take a look at what is happening with Puma and Adidas this morning. That's going to be an interesting trade. All of that coming up next. Futures are pointing negative. This is Bloomberg.
Welcome back. Just over 10 minutes until the start of European equity trading. The first time that European equity markets will get to react to what we heard from the Rose Garden, from the White House, from President Trump and his administration around tariffs and trade yesterday. We are expecting to see negativity. That goes without saying. We see European equity markets down 1%, maybe even 2% today. Let's talk to Ben Ram, Bloomberg Markets Live cross-asset strategist. Ben, talk to me about European assets and the ECB's reaction function here, because, yes, we're seeing European stocks weaker. Not as much as US futures, though. We're going to see European stocks weaker, but not as much as US futures are suggesting for US stocks. The euro, on the other hand, is at a 6-month high. I wonder what message the market is giving us about how the ECB is going to respond here.
Morning, Anna. I think that the markets are a bit confused this morning, if you ask me, because if you look at the euro, as you mentioned, it's rallying big. It's rallying the most in almost a month. But if you look at the German yields, they're actually going down and going down quite significantly. And if you look at the overnight index swaps, they're pricing in many more rate cuts to come from the ECB. The markets are thinking that, look, come April 17th, when the ECB meets next, they're going to have to cut rates because of what the tariffs mean for Europe's growth. Now, the ECB already expects growth to be less than 1% in 2025. And with the tariffs imposition, it is likely that the ECB will have to revise its growth guidance lower. Now, that growth revisions are unlikely to come in April. They are likely in June. So therefore, I don't think that the ECB is going to be in a hurry to cut rates, even though the markets think so. The ECB, the European Commission president has told us that, look, the group is going to meet next week, early next week, and then the ECB goes into a quiet period, and it is unlikely that the ECB will have the reaction time to kind of tweak their forecast in time for the April 17th review. So I think that in the meanwhile, German bonds are likely to keep rallying nevertheless. But I think that the markets are fundamentally wrong to think that the ECB is going to cut rates well below 2%. I don't think that's happening. And these tariffs are meant to be negotiated. So let's see.
Ben, gold's down this morning. Has it peaked?
No, I don't think it's peaked, even though it's a very overbought asset guy. I mean, we have seen a humongous rally since the end of 2022. It's heavily overbought. There's no question about it. But if you look at the history of gold, whether it is 1979 or during the global financial crisis, some of its best moments in history have come when the economy has gone into a tailspin together with a crisis. And now it seems like we are on the cusp of another global economic crisis because of the tariffs and the replumbing of global trade. And therefore, I think that gold is going to rally further. I think that, it could go easily to $3,500 an ounce, and it has got momentum behind it. And also the central banks, if you look at the reaction function, they are going to kind of load up on gold reserves, because where are they going to go? The US dollar is they're not too sure about how the US dollar is going to fare in this trade, paradigm where tariffs are being redrawn. So I think that the safest haven, the cleanest haven for the markets is gold at the moment, even though it's overbought.
All right, Ben Ram, our Bloomberg Markets Live cross-asset strategist, walking us through some of the currency plays there. He was talking about the dollar. Just point out that we're at 12.58 on the Bloomberg Dollar Index. 12.55 was the day after the U.S. election. So really seeing some major weakness in the currency picture. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So a lot of sectors in focus today, given the tariff announcement yesterday, but the ones that caught my eye in terms of the market action we've seen overnight. I'm going to start with energy, because this big drop in the crude prices overnight, down 2.7% on the Brent price. That was on track for its biggest decline since around October, before coming up very slightly. But this is surely going to feed into the energy stocks here in Europe today. So we're going to keep an eye on Shell, BP, Total Energies, Eni, and also Repsol over in Spain. All the big ones that have had pretty decent gains for the year. So potentially there's going to be some downside given those double-digit gains across that sector year to date so far. Then in terms of shipping, the price of Costco over in Asia was catching my eye. That one was down 7% because, of course, with increased tariffs, the demand for goods moving in freight shipping is going to decline surely, and therefore we are seeing weakness in the Asian shippers, and that is likely to feed through into Europe today. So I'm going to be watching Maersk, Hapag-Lloyd, DSV, Kuehne + Nagel, all of the big companies. Not been a great start to the year for those. Potentially some of that negativity priced in, but it could potentially be weaker. Then in terms of luxury, Prada, that one was hit hard in Hong Kong. We were down around 5% on that one, so I would expect that to feed through into likes of LVMH, potentially Hermes. Bit of a mixed year for those, but potentially luxury is going to be hit today.
Joe, thank you very much. Our equities reporter, Joe Easton. So we brace for European markets to respond to the tariffs. US futures are down more than European futures, but we are waiting to see Euro Stoxx 50 futures suggest down 2%. We'll be back with the market open next. This is Bloomberg.
Thursday morning, good morning. I hope you've had your coffee because things are about to get very lively in Europe. This is the reaction in US futures last night. I've got a 2-day of US futures to what we got out of Donald Trump in the Rose Garden. Initially, we saw a bit of a spike higher. We thought it was only going to be 10%. Then the reality struck, and you can see the impact straight down for US futures, and we bump along the bottom. We're waiting for the next step. How does this all ultimately get priced in across assets remains to be seen. We're about to get early clues. I don't think it's the full picture, Kriti, but the initial reaction, certainly in risk assets, pretty negative.
Pretty negative, but perhaps slightly better here in Europe, because I'm looking at almost a 3% decline in the U.S. futures, as you pointed out. But take a look at what Europe is doing. Euro Stoxx 50 futures are only down 2%. Even look at the DAX, and it is down about the same margin. And I say only, Anna, with a giant grain of salt, because we don't know what happens in about 60 seconds' time. But it is still key to know that Europe not selling off to the same extent that the U.S. is.
Yeah, and the extent to which we end up seeing retaliatory measures from other parts of the world against the United States could still be the big unknown out here. Let's have a look at where we are on some individual sectors and stocks that could be really in focus today. I'll start with the top of the board. Energy, yes, we could see movement there. So even though some energy and commodity products have been exempted from some of these tariffs, we have seen through the Asia session that energy prices have been weaker. Oil prices are down, various basic commodities are down. So oil prices down by 2.9%. So we'll look for that to really cross pretty strongly into London and other markets. Shipping in focus, the likes of Hapag-Lloyd and Maersk, if we're not going to be sending stuff around the world quite so much, then is that going to have an impact on their businesses? We'll watch that. And Siemens doing a deal transatlantic. Is it a good time or is it hard to price a transatlantic deal right now, Guy?
Yep. There's a lot of things to talk about this morning. Deal timing is probably one of them. But let's talk about the opening trade. Here we go. This could be one for the ages. Thursday the 3rd, European markets are opening. We are anticipating that they will open sharply lower, but as Anna's been pointing out, it could be a moderate move compared with what we see over in the United States, and that is what we are getting. The 600 is down by 0.8%. London is down by 1%. Remember, the UK only hit with 10% tariffs. The rest of the European Union hit by 20%. The IBEX is therefore down by 1.6%. A bigger reaction. The CAC opens down. The luxury stocks are certainly, I would expect, taking a hit this morning. That is down by over 2%. 2.2% is the drop that we are seeing on the CAC 40. I suspect we may have to wait a little while for Germany to get going this morning. Switzerland, remember, hit very hard overnight by this tariff story. We'll wait and see what happens with the SMI. How are the pharmaceutical stocks going to be affected by all of this? So we are down. The Stoxx 600 is down by 1.3%, Kriti, at the moment. The CAC is taking a bigger hit. The sector story is going to be interesting this morning.
It absolutely is. I'm already seeing some interesting individual movers, but let's start with the downside and what's driving this market lower. If you're looking for that cyclical exposure, that growth exposure, that's where you're getting hit the hardest. I'll give you some examples here. The Stoxx 600's biggest weight this morning is ASML. So that chip story, perhaps out of Asia, is going to be crucial. Of course, you know, Taiwan's chips has been exempted, but of course the supply chains that are sending into Japan, South Korea, and arguably even China as well is going to be having an effect on the likes of ASML. But then all the cyclicals in terms of things like commodities, in terms of things like the miners, that's where you see pain. Even some of the banks are taking a big hit. In the green, though, and I think this is interesting, utilities from a sector basis, I'm seeing plenty of pharmaceuticals, Anna, in the green this morning.
Yeah, absolutely. And some of those drinks and food companies also not doing too badly. So if you look at things on a percentage basis, Diageo and Danone, the best performers on the Stoxx 600. Down at the bottom end of the scale, though, Guy, you'll be interested in this one. I'm seeing a lot of aviation and defence names. So Dassault Aviation down by 7%. We've got Airbus down by 5%. Keeps moving around. Can't quite pin it down, but 5% down on Airbus. So this is a sector that obviously has, well, not all of those names, but some of them have benefited from that defence, that big move into the European defence stocks. But we're seeing certainly that sector under pressure this morning.
It's going to be interesting to see how Airbus manages the tariff story. We talked about this yesterday, and just how intertwined the supply chain story is for the big aviation companies and how it's going to be affected. They do have a plant in Alabama. Will that insulate them to a certain extent? But just give you a breadth story, just to give you an idea of what is happening. At the moment, we have 73 stocks in Europe in the Stoxx 600 that are higher. We have 470 stocks are lower. So the breadth is very negative, and it goes across a number of sectors. There are 55 stocks that are currently unchanged at the moment, but the breadth is negative. Europe is off its lows. The Stoxx 600 is down by 1.53% this morning. But it is interesting to see, once again, that we are seeing a better picture. And I appreciate this is a relative trade. We are seeing a better picture emerging in Europe than we are seeing over in the United States in terms of what the futures are signalling there.
Absolutely. And still a little bit of a defensive trade based in there. If you're looking at some sort of like safety trade, the grids, the utilities, I'm looking at National Grid and moving higher, Nestle, Unilever, the consumer staples coming to your rescue. So there is this element of finding safety somewhere. Let's go back to kind of what the major reaction has been, of course, in the last 24 hours. Take a listen to what Bloomberg TV guests had to say.
It's the perfect entree to let's make a deal.
He's ran on this for the last 4 years, really, is that he needs to make sure that the other countries are paying what they deserve.
There was nothing truly consistent about this rollout. Each country truly is affected differently and to a higher degree than what I think many were factoring in.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number.
I think it's going to be a very, very bumpy road, and we may well look back on this as sort of a knife edge of the economic prosperity of the United States for some time to come.
Joining us now, Karen Ward, Chief Market Strategist for EMEA over at JP Morgan Asset Management, joins us around the table. All right, Karen, we're seeing this massive sell-off. It feels like people are panicking, but we were all bracing for a bigger reaction. What are the markets telling you this morning?
Well, I think there's no doubt that what's been announced is on their larger end than what was expected. And I think as well, perhaps the consensus or hope was that there would be clear conditionality, which would, if you like, set the stage for how, as long as you do this, you won't be faced by this, maybe some staging, some further deadlines. Whereas I think what's clear is that the absolute numbers are higher. They're coming in faster, and there's not that sort of obvious conditionality which sets the stage for the deal. And therefore, pulling this back, it isn't quite so obvious how that process will happen. And I think it's just teaching us all a lot about what this administration's vision is, who they're speaking to in that U.S. economy, and what they're willing to go through in the interim to get to that vision.
It's not a secret here that uncertainty is plaguing everybody, from equity investors to bond markets to currency investors as well. Even around the table, we're scratching our heads about what comes next. What do the markets need to rally from here?
I think a clear sign that we're going to change direction. And I think we are far from any point at which we will see that. I mean, we've we've just seen, as I said, that it's not as if there's a number of staging posts for how these numbers can be walked back. So I suspect over the next few days, the story is going to be about retaliation, how bad it's going to get. But maybe what we should, as we take a longer-term view on this, there are reasons to keep your chips on the table. And I think that they are, how if it is becoming increasingly damaging, if there are signs that that pain is perhaps not worth that end goal, whether that's market pain or economic pain, we would expect to perhaps see a change of direction. But also what the other stimulus levers are that will be pulled, I think is really important for thinking about how you trade this. Because, for example, let's think about what we're seeing at the moment, the rush into bonds, the rush into that safe haven asset. If the next chapter in the story is mass fiscal everywhere as everybody's trying to revive their domestic economy, maybe that's not where you want to be. So I think that's the process we need to be thinking through. And maybe just, what I'm doing increasingly is just stepping back and thinking, OK, well, what is happening here? What I think is increasingly clear to me is the president is speaking to this part of our population that we know did not benefit from globalization. The IMF has been talking about those left behind for decades, and we haven't really seen anything to speak to that part of the population. That's who President Trump is speaking to. But we in Europe, we're seeing the same thing. We're just a few years behind. That part of the population who were left behind are voting, they're speaking, and this is going to unpick a lot of the fabric of the economy that we have seen for the last 20 years. So for me as an investor, it's really thinking about, right, if we had 20 years of globalization that created winners and losers, who were they? And if this is going into reverse, maybe the past losers will be the winners and maybe the past winners will be the losers. And that creates you a longer-term investment strategy.
OK, I was going to ask you, taking a step back, how big a rethink for the global economy is this? But it seems as if you've done the work for me there, Karen, because you've been answering that question. So let me go to the markets then, because we're seeing big response in some really interesting places. On the one hand, bond markets factoring in more cuts from the ECB. On the other hand, the euro rallies. Where does this leave Europe?
Well, I think we've seen Europe rising to the challenge. I've always said Europe is actually best in a crisis. It's when there is a common adversary that Europe galvanizes together and usually puts in place some pretty meaningful steps in terms of how the region is institutionally set up. The pandemic gave us the recovery fund, the first stage towards a fiscal union. This, I think, will move us towards Eurobonds. We will see common issuance of a much greater scale in order to provide that defence funding, in order to provide money for supporting the domestic economy. So I think that is why we are seeing what at face value, and it comes back to this point, as we're investing, we've got to think about, OK, well, that's the first move. What's the counter-stimulus? Europe will keep stepping up with domestic stimulus, and that is why, and part of the stimulus is the ECB. So what we're seeing from Europe is monetary, fiscal and regulatory stimulus. Don't forget all three. That is why you're seeing European assets relatively outperform, the euro outperforming, even though rates are coming down.
Are you actively looking at anti-globalization trades then? From what you've described, this isn't just a US phenomenon, this is something that will go wider. And so if we've seen this huge turning point in globalization, how do you invest into that?
I mean, we could be here for a couple of hours, but let's give you a few headlines. Because I do think, we have to read the room of what the electorate are saying across the West. And that is that the benefits of globalization haven't been felt by all. Rising inequality is very clear. And everyone, the politics is making everybody turn inward, whether that's through migration, whether that's through trade policies. To me, it's the direction of travel. So it is partly about thinking about winners and losers. OK, well, you're going to have significant onshoring. You're going to have much more protection of domestic industry and its pricing power. So there are going to be winners there. At the same time, there are going to be losers of those who particularly have relied on that external. But the biggest one, Anna, is thinking about inflation. Thinking about how that 2 decades, because globalization gave us that massive fall in prices. In the UK, our goods prices did not increase for 30 years. Our basket of goods was the same price in 1990 as it was in 2020. That's all going to reverse. So how do I protect my portfolio from inflation is the absolute most critical. What bond yield am I going to ask for in a higher inflation world? How do I use alternatives? There's lots to be doing to get away from the noise, but setting yourself up for the future.
Yes, and perhaps that electorate that you're referencing, Karen, maybe not thinking enough about the inflation side of things and thinking more about the jobs and the growth side of things.
Well, let's talk about the growth side of things, Karen. Is this a zero-sum game? You talk about a redistribution. Is the redistribution symmetrical, i.e. from the winners to the losers, or is the net effect of all of this a smaller economy?
I would think the latter.
Right.
I mean, most of the evidence has suggested that on aggregate, globalization has really benefited. A large part of the population has developed productivity and competitiveness that's raised total income. So this, I think, brings us back into this question of over the next few months, how does this story play out? And do policymakers have a rethink about the direction of travel? Because in essence, what you could say President Trump is doing is speaking to that part of the election that elected him, that want the factory job that their father had. Sure. But maybe that's going to be at the expense of the other 80% of the population who are going to experience the higher prices. So how does it then interact with, how the policies play through the economy? If it is weaker, aggregate growth, if it is rising unemployment, if it is rising prices, maybe he can't do this to even speak to that 15%.
Those factory jobs kind of existed in the 1950s. Before that, we had the 1930s.
Yeah.
Tariffs, the last time we had tariffs like this, I think Smoot-Hawley was cleared by the House in 1929, in May, before the October crash came through. The economy starts reacting quite violently. You get into the 1930s, you get the Great Depression. How big a risk is it that we see that kind of a growth hit as a result of the sort of tearing asunder of what has been a post-war economic framework that has produced higher GDP? Why can't that go into reverse? Why won't that go into reverse as we work our way through this process? Is that a useful model to think about what we are about to see in terms of global economic growth?
That is a useful model for analysing policy error. So what happened back then was not only political policy error, but then monetary policy error.
Sure.
And so that, I think, is useful for us thinking about if we take economics out of the equation and things are operating purely on political will, those are the risks. Now, I would hope, as an economist, the lessons have been learned, and therefore I still put the risk on that kind of outcome pretty low.
But you've flagged inflation. If the ECB cuts, isn't there a danger that provides some cyclicality into that inflationary narrative?
So I think what we're working out on the inflation front and whether the central bank should be reacting is this a one-time supply shock which is going to raise inflation but ultimately damage growth they should look through and be cutting? Or are we going to see a supply shock coupled with fiscal, giving us the demand shock we saw in the pandemic, much higher inflation, in which case the central bank should be hiking? At the moment in Europe, we're looking at the former. But we need to be very careful about thinking when we transition to the latter.
Very quickly, you talked about this deglobalization trade. There's a question if the rally we've seen in periphery bonds and periphery equities in Spain and Italy is over. This quarter was kind of a one-time exception. Does deglobalization create a case to be long that part of the world?
That and many others, Kriti. I would say that if we think that what's happening, and this isn't going to happen today, this is a multi-year process, but if we really think that what the world is doing is fragmenting, really, into friendship groups, alignment groups, there are going to be significant winners. It's not going to maybe just be the South. It might be Eastern Europe. It will be in Asia, again, those that will benefit perhaps from trade links changing with China, there's going to be significant winners alongside the losers. And that's the work to be done today, is not to panic, not to sell everything, but to think about these reshufflings, think about how the fabric's changing, and find the winners now, because over the next 48 hours, we're probably going to have great opportunities to pick those up.
Friendship groups. Different friendship groups.
Falling out with all our friends, it seems, all over the place.
All kinds of things are moving at the moment.
We've got a friendship group here.
We definitely have.
We're very happy around this desk. Yeah.
Karen.
Thanks, Karen.
Nice to see you. Thank you very much indeed for coming to see us. Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Let's take a look at the core six in Europe and figure out what is happening here. You are seeing certainly a defensive bid coming into names like Nestlé this morning. As you can see, it is rising in this down market, up by 0.5%. Novo's also catching a bid. Farmers broadly are being perceived this morning as a place to hide out, as is Ferrari, which is interesting as well. Chips under pressure, Schneider's definitely under pressure, luxury certainly not having a good day as well. That is where the weakness is percolating in this market. Individual stock moves, let's get a few more. Joe, what do you got?
Another area not having a good day, guys, is the shipping stocks. We're seeing big moves lower in the likes of AP Polymers, also Hapag, Lloyd dropping. Pretty simple trade on this. A lot of reduced demand.
Okay. You're probably hearing Joe on my mic because his mic doesn't appear to be working.
That's how these things work.
Yeah, precisely. We'll try and fix that little technical glitch this morning. We're running with a number of issues.
Yeah, he was talking us through the shipping stocks, which are obviously weaker because, as we were just discussing with Karen, if you're going to be less globalised than you were, then maybe you ship fewer goods around the world.
As a result, we are seeing maybe also some of the luxury names coming down as well.
Yeah.
We're going to be shipping some of those goods a little less. It's interesting to see what's happening with Adidas and Puma. Puma, I think, is now down 50%.
And the banking sector, the worst performing, actually, which is probably a rate story.
Yeah, if you're worried about any sort of cyclical exposure, today is not the day to be looking at the markets.
OK, we will fix Joe's mic. We'll bring him back with all of those crucial details about where the market is moving. We will also take another look at what's going on in terms of winners and losers. We'll be looking at that coming up next in the wake of President Donald Trump's tariff announcements. We'll bring you that shortly. This is Bloomberg. Welcome back to the opening trade. 21 minutes into a European session that is under pressure, down by 1.7%. We see the German market in particular under pressure, down by 2.1%. Actually, there's not much between them now, the German and the French market. So both under pressure, down by 2%. US futures, it is worth keeping saying, though, are under even more pressure. E-minis and Nasdaq futures down 3%. Let us check in on some of the individual stocks that are on the move, because there's some really interesting moves beneath the hood. And Joe Easton is back with a mic and can talk us through some of those movers. Joe.
So one sector hit hard, Anna, is the shipping sector today. We are seeing significant weakness in the likes of AP Moller-Maersk, also Hapag-Lloyd hit at the open of trading. It is a simple trade on that one. A lot fewer goods potentially moving around the ocean in freight shipping, and therefore reduced demand. Potentially that means we're going to see freight rates coming back down once again. We can clearly see that some of these tariffs potentially bigger than expected, given the moves we've seen in those drops in those shipping companies. Really interesting there. Then one luxury stock catching my eye at the open. A trader flagged this one to me, Pandora. Now, Pandora makes a lot of its charm bracelets and other jewellery over in Thailand, and Trump slapping a 36% tariff on Thailand, really hitting that stock. We can see that was one of the worst, if not the worst performer across the European market today. Pandora hit as those goods coming out of Thailand going to be hit really hard by those tariffs from Trump. And we can actually see a broader move lower in luxury. Remember, some of these stocks, including LVMH, was already weaker on the year to date, but potentially this does mean fewer demand from the US for these goods, for all these handbags and other jewellery, watches, that kind of thing. So we're seeing significant losses across luxury today. And then just to finish on energy, because we did see that 2.6%, almost 3% drop in the crude price overnight when we came in this morning, that feeding through into the large cap names today. We can see BP coming down around 2.8%. Shell, Total Energy, all of them hit, potentially just tied to the impact on GDP, on economic growth because of these tariffs, and therefore lower demand for energy. Lots of red on the screen. I got there eventually, and we are seeing energy stocks dropping.
Thank you very much, Joe Easton from our equity team. So that's the movement on the day, Guy. Taking a step back then, we think about winners and losers.
We do. I think it's quite hard at this point to really determine exactly what the longer-term picture is going to look like. But we do know clearly that there is going to be a big shake-up, that things are going to change significantly. Joe was talking about Pandora. We're even going to see divergence within sectors, and I think that is quite interesting as well in terms of the narrative that we are going to be talking about. Charlie Wells is here, maybe, to think about all of this. Walk us through what you've seen.
Yeah, Guy, we're just a few hours in, but really the theme that is kind of screaming out this morning is the geography plays that people thought might work maybe aren't. And so you can see that if you look at some European beverage companies, for instance. So we've got Diageo and we've got AB InBev. And you would maybe think that Diageo, 39% of their sales are from the U.S. AB InBev, it's 25%. You would think that, you know, Diageo might be more exposed there, but they seem to be performing pretty well on the stock market today. And so that may come down to a different geographic element, which is not necessarily U.S. exposure, but what country is that company in? Diageo here in London, AB InBev in Belgium, of course subject to different tariffs. So it's just feeling like 3D chess.
It's fascinating that we talk about this kind of geographical breakdown because the last Trump administration, the playbook was very much Buy America. Is that still kind of vaguely true today?
Yeah, so, I mean, Buy America seems to be helping some companies, but you talked about that kind of previous Trump playbook. And if we think about the kind of European retail, European athleisure space, this is where that new playbook needs to be even newer because a lot of companies, I'm thinking about Puma, I'm thinking about the likes of Nike, obviously that's American, Adidas, instead of sourcing, instead of making their products in China, they moved to Vietnam thinking about Trump. What did we see yesterday? 46% new tariffs on Vietnam. And so that in the market is looking like it's taking a lot of these sportswear companies down. They thought they could geographically diversify, and actually that play that was supposed to help them, at least right now, is looking like it could bite them.
Autos also in focus for you, Charlie.
I mean, it's been such a mixed picture here, and I think that geographic spread is something that a lot of these companies thought could potentially benefit them. So you think about Tesla, you think about Ford, less exposure there to these tariffs because they do make a lot of parts in the U.S. They do construct a lot of their vehicles there. But even Tesla in recent weeks was urging caution. And of course, you could say that potentially these autos kind of came out winners because they weren't subject to new tariffs, but those 25% tariffs came into effect at midnight.
All right. Bloomberg's Charlie Wells walking us through the sectors and maybe how they're digesting them. This is just part one. This is just country tariffs. We're still expecting the sector tariff to come within the next few weeks. Of course, we've already gotten a taste of that, as Charlie mentioned, in the auto space. Coming up, we're going to talk about this tariff reaction through a different lens, this time through the currency markets, and specifically how they may be reacting or maybe not reacting. If we're talking about these geographical borders, both Karen Ward and Charlie have mentioned, is that where it shows up the most? Sonia Martin from DZ Bank is going to be joining us next. We'll talk to her a little bit about maybe where Eurodollar, where cable is going to be headed next, and how long this dollar weakness will sustain, not to mention some of the Asian currencies that are very much in focus as well. That conversation next. This is Bloomberg. This is the opening trader at 30 minutes into today's session, seeing red across the screen. Although off the losses we saw at the market open just 30 minutes ago, you're looking at the Stoxx 600 down by about 1.2%. The underperformer of the morning is France, which is not how the markets opened in terms of market performance just 30 minutes ago. The DAX was the major underperformer, now down only 1.5%, so pairing some of the losses. So that's going to be certainly something that we watch. When we talk about this from a sector breakdown perspective, it is very clear that the lines are drawn around cyclical versus defensive. Some of the banks are the underperformers, whereas some of the consumer staples, some of the kind of utilities, and even the real estate story are your outperformers. So people are seeking safety and not selling off as aggressively as perhaps earlier thought. At least that's my takeaway from the story this morning.
Yeah, the other takeaway I had on the sector side, real estate at the top, banks at the bottom. So there's a rate story writ large.
The market's assuming that the rates go lower here.
Yeah.
We were talking about inflation earlier on. That's the bit of the puzzle that I'm not sure is a fully formed thought yet. The moment the market is reacting to the growth story, and we'll talk about oil in just a moment, that's definitely reacting to the growth narrative. That seems to be the overriding fear at the moment, that we get a big growth slowdown. But does it come with a pickup in inflation? I think, is the big fear. So let's talk about that now. Brent's currently trading 72.43. It's down by 3.3%. TI is down 3.5%. US gasoline is down by 4.5%. It's rallied so far this year, but it's coming off the pace fairly quickly right now. Stephen Stepczynski joining us to discuss. Stephen, this is the growth fear. Is that what we're seeing here? Is that what is happening in terms of the narrative? Crude is lower. We're just extrapolating the tariff story into a slower growth story into the crude price.
I think one thing that the market is looking at is probably China specifically. They're the world's biggest crude importer. And when you see tariffs on top of previous tariffs of 50, 60%, that's going to take a hit on the Chinese economy. That's going to take a hit on their energy demand. Now, more broadly, if there is a trade war, if there are retaliatory tariffs from other countries, you see them also potentially consuming less. I think one of the outliers, look at U.S. gasoline demand. That shows that, or rather U.S. gasoline prices. Lower prices indicates that the market thinks that the U.S. Will consume less. The economy will contract, and that's playing out in the mind of the traders as they see Trump roll out these tariffs. So overall, while energy was exempt actually from these tariffs, energy imports into the United States weren't touched, it does still show that the wider economic impact, the market, at least oil traders, are expecting a slowdown in demand, and I think in particular that of China.
Well, Stephen, speaking of China, when we're already seeing kind of headlined across the wire and across the Bloomberg terminal around the idea that oil traders are avoiding China-made ships, that was something that was mentioned when Donald Trump talked about China. I think he very specifically said one Chinese shipyard is able to make more than all of the American shipyards. He very specifically made that reference. Talk to us about how that dynamic, among others, impacts the oil market moving forward.
Well, I mean, I think the one thing that you have to focus on with that is that it could change the flow of where exports come from, where you're picking up your crude and where you're traveling. I do actually want to focus on liquefied natural gas in particular, because that might actually be one of the larger impacts. Citi had an interesting note overnight illustrating that potentially this could add the cost for exporting LNG from the United States. The U.S. is the world's biggest LNG exporter, and if this becomes a costly sort of gambit, if this becomes an issue, then that could actually force some buyers, some traders, to look elsewhere for their LNG. This could essentially reduce what they call the ARB for American gas. It's one of these unforeseen circumstances or sort of hits to the U.S. energy sector that they probably weren't thinking about when they decided to implement this sort of policy. But it's one of the areas that could be sort of an issue going forward. So I think that's one area in particular that you should keep an eye on, is the impact that this has for LNG exports, especially the cost of getting it out of the United States, and what happens with trade partners. Are they going to look elsewhere, or are energy companies going to stick with it and just take that hit and pass that cost on to consumers?
Yeah, it's interesting. And Guy was just, as you were speaking, Guy was just noting the weakness in the dollar as well. And of course, that's important when you talk about global trade of commodities. Thinking about that some more then, we've got gold prices actually a little bit weaker today, but we saw gold hit a new all-time high as a result of what market nervousness, tension, risk haven seeking, I suppose. What are you hearing about the gold price, Stephen?
Yeah, I mean, it's been on an absolute tear over the last several months, and it keeps rising higher. And I think it sort of plays to, as you were saying, that safe haven aspect. Going forward, we could see more upside. I think as the world kind of rolls out these tariffs against the United States, the EU has said that they could enact something. China has also said that they could enact something. You're going to see perhaps more of a flight to gold and other safe haven assets going forward. Silver has also been pretty punchy. Now, I think it also depends on how long the market expects this to go forward. I've been talking to traders today who are bringing up the idea that, these tariffs are going to go into effect this weekend, and then the ones on top of it, the larger tariffs going into effect next week. There are some who actually expect that this might not follow through, that this could be Trump bluffing. Now, whether or not you want to talk about the validity of guessing Trump's moves and predicting what he's going to do, I think if this does move forward, you could see more of a sort of hastening or more of a push into gold and seeing prices continue that record-breaking streak over the next several weeks and months.
Stephen, thank you. Stephen Stapczynski with a host of energy moves for us this morning. As he was talking there, he was mentioning China and the retaliation that has been pledged. Well, China has vowed to retaliate against President Trump's biggest tariffs yet. The Ministry of Commerce urged the US to, quote, immediately cancel tariffs and resolve trade differences through dialogue. Hours after Trump hiked levies on China to 34%, and that's on top of other tariffs, takes some measures of the tariff to above 60%. Bloomberg senior reporter for Chinese economics and government, James Mager, joins us now. So the burden on China is huge, isn't it, James? The Chinese government has just finished speaking on tariffs. Add up all of the response so far that we've seen from China.
We've only really seen a verbal response so far. You mentioned the Ministry of Commerce's comment. The Ministry of Commerce spokesperson, Hu Yadong, just finished speaking, but really he just repeated the things that were in the statement earlier today. And the Ministry of Foreign Affairs, again, they just repeated that statement. So far we haven't seen any retaliation from the Chinese side. And really the expectation was that they would do something symbolic, probably based on past events that will actually happen when the US tariffs come into place, which is on April 9th. Not today. But, obviously these tariffs, if they are actually implemented and they do go into force, which is, I think is likely, is going to be very damaging for Chinese exports. Not just because there are tariffs on China, but because there are tariffs on Vietnam, there are tariffs on Thailand, there are tariffs on, many other countries that buy goods from China and then put those into other products which are then exported to the US. So, for example, Samsung phones, which are produced in Vietnam, use a lot of parts from China, and then those are then exported to America. And so that trade will also be all damaged as well. So it's not just about the bilateral trade between the US and China, but these regional sort of supply chains that have been built up over decades across Asia are all going to be affected by these massive new hikes in tariffs that were announced earlier today.
James, broaden this out when it comes to the other economies of Asia as well. We've seen tariffs slapped onto the likes of Vietnam, Cambodia, et cetera. Walk us through the impact there. Is it as similar to the China story you've just laid out?
I think that the damage is going to be largest for those economies. You're looking at Vietnam. The amount of exports that Vietnam sells to America is not as high as for China, but it's it's a bigger portion of their total trade. They're much more dependent on exporting products to America. And that's partly because of the first trade war. And in the first trade war in 2018, 2019, a lot of companies moved their production from China to Vietnam. They moved from China to Thailand, to Malaysia, to other places to get away from the tariffs that Donald Trump put on China in the first trade war. And now those companies, which are suppliers for Apple, which are suppliers for, for various different companies, Lululemon, Nike, they're all making their products in those Southeast Asian countries and then selling it onto the US and also selling onto Europe and other markets as well. But the tariffs are going to be very damaging for China's economy, and they're going to push down prices in China. They're going to make the already difficult economic situation in China more difficult, but they're going to be even more damaging for those poorer countries, for those Southeast Asian countries, which are much more dependent on that trade with the US.
James, great to catch up. Thanks for the insight. Really appreciate it. James Mager joining us on what we're seeing in China and across Asia in response to the tariffs announced last night by Donald Trump. Let's get the FX take on all of this as well. Sonia Martin, head of FX and monetary policy research at DZ Bank, joins us now. Sonia, good morning. Thanks for your time. The dollar is down. The Bloomberg Dollar Index is down circa 1% this morning. Why is the dollar not a haven in this world that we now find ourselves in? Uncertainty used to equal buy the dollar. Why does that no longer apply? I'm slightly concerned that we're having more technical issues.
I
once
wasn't
again,
hearing anything. I was looking around the table to see
I
if
could see
anyone
her
else was-
speaking.
Yes.
And I know
hear
that
me
I
now?
spoke to her during the break, so I know that it works.
Ah,
there she goes. You're
there.
back. Sonia, we apologise. There was some muting that I think may have happened at some point. We definitely want to hear what you have to say. So, sorry, carry on with what you were saying.
Yes. Yes, the narrative has absolutely changed. So when you look back a few months, everyone assumed that the tariffs would be worse for everyone else. They would also hurt the U.S., but the main damage was expected to be elsewhere, and that was the fact that people looked at possibly stronger dollar. Now, what we are seeing right now is a reversal of that narrative. So people are now focusing on the economic fallout these tariffs can have on the U.S. itself, and that's what we're seeing, weighing on the dollar right now. As you said, we've seen quite a significant move overnight, and pretty much across the board. I mean, some emerging markets currency have been a bit weaker, but generally the dollar has been the big loser of last night's events.
So where is the safe haven? What is the currency du jour?
Well, when you look at what's happened overnight, then definitely we've seen the yen benefit, we've seen the Swiss franc benefit. You could argue that that's maybe a safe haven situation, but equally, it's just a weak dollar across the board. So it's a bit difficult to pick out safe havens. When you look at the yield situation, I mean, when you look at UST yields, Bund yields, they have fallen. So you could obviously see some demand there, but it's not very clear cut. And I think ultimately what's going to happen now is the question is going to shift to, are these tariffs going to be implemented in full? And maybe who's going to be able to negotiate a deal with Donald Trump? And maybe those are the currencies that we're going to have to look out for in the coming months.
Yeah, it seems we're getting mixed signals around the euro right now, Sonia. Euro resilience, but as you say, a lot of that's just dollar weakness this morning. Then you look at bond markets, and we're seeing bond markets factoring in cuts from the ECB. Where do you think the euro goes from here?
If I had a dartboard right now, that would be useful. Currency markets have been incredibly volatile these last few months, and it's very difficult. We keep making forecasts, things happen, everything changes. Definitely, we've had a few significant changes that have happened in recent months, and one is the narrative vis-a-vis the US has been shifting towards a more negative outlook, and at the same time, we obviously have a more positive outlook when you look at Germany in particular, given the big fiscal spending plans of the new government. So all of that does obviously support the euro. The big question will be, well, how is the Eurozone going to react to those tariffs? For one, what's the economic impact? How much damage are these tariffs going to do? And are they going to be retaliatory measures? And what are these going to do? So that's going to be the big question in terms of the growth outlook for the Eurozone. But the euro is definitely looking a lot more solid today than it did earlier this year.
Yeah, the euro is looking solid. I wonder which currency pairs are you looking at then? Sticking in the European region, I'm going back to the Brexit favourite, euro pound, euro cable, and wondering whether you see any opportunity there given the different rates of tariff that the US has imposed on those different geographies. Or where do you look to interesting currency pairs?
No, I think, to be honest, I think right now it's too early to say that simply because we don't know how this tariff conflict is going to play out, right? As I said, I think the focus is going to be on which countries can maybe negotiate a better deal with Trump. And obviously the UK government is trying to do that. And which countries are going to fail in doing that and therefore be hit much harder economically by these tariffs. And that's going to be the big sort of deciding factor. And I think right now everyone's just scrambling to keep up with what's happening in Washington and trying to figure out how to best move forward from here. So I think we're just going to have to wait and see a few more days what happens next.
So, Sonia, let's continue our tour around the world. Guy asked about the United States and asked about Europe. I'd like to circle right back to Asia. There has been this dynamic that's really based on trade flows between the Chinese yuan, the Japanese yen, and the Korean won specifically, where they all kind of trade off based on the trade flows with the United States at the expense of each other. What drives those currencies if U.S. trade flows maybe don't?
Well, I think there are very different cases. I mean, obviously, China has been very hard hit by this latest round of tariffs, and we'll have to get to see how the Chinese government plans to deal with this and what measures they will take in turn. When you look at Japan, we have a big domestic issue in terms of what's happening with monetary policy there. That's playing a big role. I mean, maybe right now people aren't so focused on that, but that is definitely a domestic factor that plays a major role here as well. And we have, as we've seen this morning, some safe haven interest there as well. So I think these are factors that have to be taken into consideration. We're definitely looking at a weaker Chinese currency simply because, growth-wise, China is not looking particularly attractive, and we're looking at a stronger yen. But that's also partially, at least, the result of the expected shift in monetary policy, or the continued shift, should I say, in monetary policy.
Well, Sonia, talk to us a little bit about that yen story, because, of course, as you're speaking, we're seeing that divergence in front of us in those Asian currencies, where every other Asian currency is weaker right now, except for the Japanese yen. I understand that part of it is from the BOJ. Is there also that safe haven aspect of it, this repatriation theme that may be coming from Japanese creditors? I'm curious if it's something that we see, for example, in the Swiss franc as well.
Yes, I mean, that's been an ongoing story for some time, right? I mean, the question of whether Japanese investors are taking money back home as well, because, obviously with rates rising in Japan, the yield difference maybe has obviously shrunk, but the US still remains much more attractive. And I think it's a political situation as well. People have to make a decision, I think, on the US. Do they trust, which is a difficult word with Donald Trump, do they trust the US to continue to have responsible fiscal policy? So that's going to be a big question there. But I think, yes, there is some repatriation. There is some interest to take money back home. And, with the BOJ on a path to hike rates further, and obviously they have withdrawn from the JGB market or withdrawing from that market, that's definitely a prospect, and that is driving the yen. But I think there's also a safe haven argument to be made here this morning.
Sonia, what does that do to the carry trade? I mean, it feels like after the carry trade kind of unwind of last summer, people were hesitant to touch it for a while. Does this dynamic that you just laid out with the Japanese yen and the tariff pain potentially for a lot of Latin American countries, bring back the carry trade between, say, the Japanese yen and the Mexican peso?
I mean, obviously the yield differential is really attractive. The problem is that, especially when you look at Mexico, with Trump, being as unpredictable as he is and his trade policies being as erratic as they are, I think these trades have an incredibly high risk factor. I mean, the volatility in these markets can be massive. And I think for investors that are willing to go there, yes, the yield differential is attractive. However, you have to be able to sustain some short-term pain if you're going to be in these trades, because it's literally impossible right now to predict with any accuracy what's going to happen in the next few months. So it's a very high risk trade at this point, I would say.
Dartboards. We're all going to need dartboards. Sonia, is the pound a safe haven?
Yeah, I'm not. No, I don't think so. I think with the fiscal policy situation in the UK, there is too much at risk here. I mean, they're really struggling right now to get things in order. When we, obviously saw the budget last week, it's all a bit chaotic right now. I don't necessarily see the pound as a safe haven design environment, unless Keir Starmer manages somehow to make a great deal with Donald Trump, in which case, yes, maybe. But otherwise, I don't think so.
I think we've covered maybe every currency in the world with Sonia Martin this morning. We thank you so much for your time. Head of FX and Monetary Policy Research over at DZ Bank, right on the back of those tariff announcements coming out of the United States. In the meantime, let's get a quick check on these markets here, because the sell-off continues. Euro Stoxx 50 down about 1.8%, off the lows that we saw earlier in the session, but still certainly seeing underperformance here in Europe. The CAC 40 seems to be getting the brunt of it, down about 1.7%. The FTSE 100 not selling off as much, only down 1%. We're going to keep you apprised of these market moves. Stick with us. This is Bloomberg.
Welcome back to the opening trade. It is, well, we're 52 minutes into what feels like a lot longer of the European market session this morning. We're down by 1.5% on European equities as a whole, down by almost 2% on some of them. As you can see, the CAC 40 are certainly under pressure. Let's show you some of the interesting sector stories that are evolving here. There's a rate story developing across these sectors. Real estate is the best performing sector this morning. Banks are the worst. More on that in a moment. But in terms of some of the sportswear makers, we were hearing earlier on in the programme, if you've produced in China, or if you used to produce in China and you move that production to Vietnam or other places around that region, then perhaps you're being caught up in some of this tariff news, and as a result, your stock goes lower. That's what we seem to be seeing in Adidas and in Puma.
Some continued pain in the banking sector as well. Basically, I think the takeaway here is that if you are banking in a country, or if you're headquartered or at least have multiple exposure in a country that's getting hit hard by the tariffs, you are seeing the most pain. So I'll give you an example. Standard Chartered, which of course has that major Asia exposure, down a whopping 8%. It is your biggest banking underperformer this morning. Commerce Bank as well, right on its heels, down about 6%. Those Swiss tariffs potentially not helping UBS either. I think about Unicredit also. I should mention that the Spanish stocks, which have exposure to a lot of Latin America and Mexico as well, Santander, BBVA, They're down, but they're only down about 1%. So that, I think, really tells you about the dynamic you're seeing in the banking space.
E-minis are down by 3.1. This almost feels like the calm before the storm. We're waiting to see what's going to happen on Wall Street a little bit later on. Let's talk about also what is happening in the bond market. Front end of the German curve, front end of the US curve, telling really different stories this morning. Not completely different stories, but there's a notable divergence, which I think is fascinating. The front end of the US curve, down by 4.9 right now. So let's call that 5. So we're down by 5 on the US 2-year. The German 2-year is down by nearly 10. There is a huge divergence, to your point about what is happening in the banking space as well. Huge divergence in terms of the rate story this morning, and that's telling us a lot about thinking around the ECB and the Fed. Val's got that story. There's so many elements that get folded into this story, but the basic takeaway is the Fed is going to be later than the ECB in cutting.
Yeah, and I think that's why we're seeing such an outperformance in euro-dollar this morning, maybe in a perverse way. The ECB is cutting more, but that's just going to help growth in Europe, and hence we see this euro-dollar outperformance on this risk-off move. Now, it's interesting to see the fact that now for the April meeting, when it comes to the ECB, we're pricing a 90% chance of a cut. But if you look at the next meeting for the Fed, that really has not budged. The market still believes that this is a Fed who needs to wait for evidence of the economic slowdown in the hard data before they pivot to cut. And why is that? We're all worried about the impact of inflation on the U.S. economy. Very interesting analysis. You have to take a look at Anna Wong's piece, saying that, yes, inflation could be transitory in her model, but it might take 3 years to return to baseline.
That's not transitory.
That doesn't sound very transitory to me, but that is the pickle what we're seeing right now. So maybe assets in Europe are the haven you want to be in because the ECB is more likely to be there.
But that's because they're perhaps not eyeing the inflationary impact, whereas the United States very much is. What are the markets trading off of, growth or inflation?
Oh, it's all about growth this morning. But I want to note we did have an ECB member this morning saying that this changes the growth picture for Europe, but it doesn't change their path of inflation here for Europe. And that's just a hint that there's going to be more ECB cuts to come. But remember, for Europe, we not only have the fiscal stimulus, we now might have the monetary stimulus. And I heard someone else talking on TV just a few moments ago talking about regulatory stimulus as well. Europe seems to be the haven. In a very odd way.
It does, doesn't it? And we just have time for a little flashback to the financial crisis, Val. We're checking the iTraxx crossover index. This is the risk of default on European junk, and it's rising.
Yeah, it's rising. It's taking one of the biggest one-day jumps in almost 7 months. I want to say, though, that European credit spreads are widening as well as U.S. credit spreads. So it seems to be a global worry about an economic slowdown taking place across the credit market.
Thanks, Val. Great stuff. Look at the markets. We have Howard Lutnick joining us a little bit later on. A look from the US side. We've also got Jonathan Reynolds from the UK side joining us a little bit later on as well. Some great guests coming up on Bloomberg. This is Bloomberg.